If you're like me, and part of the fun of being in the market and paying attention to the markets is really just about the drama and not just about making money, then you've picked a great day to watch the show. Um, for regulars to the channel, you know that we divide this program into three parts. We get the Tesla news first, followed by the economic news, and then finally we do the numbers. Well, today the economic news is stunning and critical, even though a lot of it's late because of the government shutdown. But you want to hang in here for the second half of the show. No, the second third of the show. And for those of you who duck out before the numbers, drop a comment and let me know why the numbers don't matter, or at least my analysis of those numbers doesn't matter to you. I think it's something that if you listen to every single day, it reminds me of, baseball stats or football stats. If you miss just a few weeks of those stats, you can lose your really kind of the whole notion of what's going on in the league. Anyway, let's talk about Tesla for a minute. This may seem like a song that I've always been singing, but at least we have a new verse. And the new verse is if Elon Musk says that Tesla, quote, will build chips at higher volumes ultimately than all other AI chips combined, end quote, then based on his track record alone, I just assume that barring big changes in the science or the markets or something, this is going to happen. As Elon notes, Tesla already builds millions and millions of chips, for the cars and for the and various uses for their Colossus, not Colossus. I'm always getting it backwards. Yeah. Anyway, so if they're going to build 10 million or 100 million humanoids a year and 3 to 5 million vehicles a year, and support the massive data center in Austin. Who knows what's coming next? Their own internal requirements will be massive. Just to fit what they need will be massive, which is kind of what he's talking about. But then this is long before we get to the second part of what he talked about the other day, and that is putting these chips in space for XAI or for others. So it's a crazy, crazy, huge deal. And it's part of what moved markets yesterday, I believe, even as markets sell off today. We'll talk about that a lot more as we move through this. Anyway, not included in the reporting yesterday regarding that Melius research analyst, Rob Wertmeier, all of his amazing positive statements, which I think was the biggest move of the market yesterday. But today, I finally get the other part of the story. He's all in on disruptive potential of self-driving cars, and he rates Tesla stock a buy. Price target $5.25 per share. And overall, according to Barron's, 41% of analysts covering Tesla stock rate the shares a buy right now. That's pretty good. Okay, NVIDIA is down today because Meta says it might start buying TPUs from Google instead of GPUs from NVIDIA. And Meta is one of the largest buyers of chips. This would certainly impact NVIDIA and certainly tends to confirm fears that NVIDIA could eventually face lower margins, lower increases in sales volumes, etc. Last night, I'm sorry, I have to put my power on. I couldn't find the power cord. Last night, Larry and I took an extremely deep dive into this. I'll put the card up on that later if you'd like to see. Larry had some extremely very interesting things to say about it. This is Randy Kirk, by the way. Now we're going to get into that economic news I was telling you about. There's so much of it, but let's keep going. Let's start now with, we had a bunch of retailers that came out with their earnings today and their guidance, and the top takeaways, this would be mostly Best Buy, Dick's Sporting Goods, and Kohl's. These retailers' reports released on November 25th paint a picture of resilient but value-conscious U.S. consumers heading into the holiday session. Despite macroeconomic pressures like inflation and the impact of tariffs, early indicators suggest steady discretionary spending with a focus on deals, tech upgrades, and experiential retail. So number one, we have there was beats across the board from all of these. All three companies exceeded expectations. Then we have value-seeking behavior dominates discretionary spending. Consumers are prioritizing promotions and deals. As seen in Kohl's 800 basis point rise in coupon penetration, Best Buy's note on shoppers waiting for sales events. Dick's highlighted strength in premium footwear and golf without slowdown signs at all. Then you have Best Buy saw 2.7% comparable sales growth driven by computing, gaming, and mobile upgrades. Experiential. Upward guidance revisions point to an optimistic holiday outlook. Entering the Christmas season, every one of them, all three, raised full-year forecasts. Kohl's now sees net sales down 3.5% from 5.6. What? Okay, I can't quite make all that out. All right, then what about this interview this morning with Michelle Meyer? She is with Mastercard, and this is on CNBC. This was robust consumer spending continues. U.S. consumers remain highly active in spending, showing resilience despite economic headwinds. You know, the economic headwinds that they keep talking about, the inflationary and the tariffs, they're not there. It's all put in the minds of the consumers by the headlines in the mainstream media. We'll see in a minute. You'll see there's no inflation. I mean, the inflation is around, 2.5%, just where the Fed wants it, 2.7. I mean, it's really not a problem. And the tariffs, which are causing part of the inflation, whatever inflation there is, tariffs are causing some of that, but it's not nuts. It's not crazy. Now, somebody pointed out today, okay, on maybe some toys, some of the other items that people are looking at for Christmas, the tariffs would impact more, of course, obviously. All right. Holiday, U.S. consumers highly active in spending. Holiday season optimism, early holiday shopping indicators point to a strong season driven by pent-up demand, promotional activity. Expect to exceed last year's figures. Shoppers are increasingly seeking deals and discounts. Credit card usage is on the rise. Noticeable uptick in credit card reliance for larger purchases, signaling some strain on household budgets, but not yet a red flag. Solid job market underpinning consumer confidence with low unemployment. This is what Mastercard is seeing. Inflation moderation helps. Cooling inflation, she says, is easing pressures on wallets, allowing consumers to allocate more towards non-essentials without cutting back drastically. Cooling inflation is what Mastercard is seeing. Urban areas are seeing higher luxury spending, while rural and suburban consumers focus on essentials. They say that online sales channels continue to outperform brick and mortar. Other people are saying, like Kohl's and others are saying, hey, there's an uptick in that brick and mortar traffic also. Meyer projects moderate consumer spending growth of 2 to 3% next year, assuming no major policy shocks, with a focus on sustainable rather than exuberant expansion. And she says also upcoming fiscal and trade policies could influence spending patterns with potential tariffs. I think the tariff situation is over and going to be becoming less and less of an issue going into 2026. I think, as I said the other day, I believe tariffs will continue to impact the overall inflationary picture into the first half of 2026. But after that, not at all, because then you'll have year-over-year comparisons, which will already have the tariffs baked in. Moreover, I think that the tariff wars are over. And so if anything, they'll be moderating as opposed to going up more. So Mastercard seeing things doing very, very well. Then you get ADP coming out, and they're saying that, that we're back to 13,500 job losses per week. Now, that was where they were a couple of weeks ago. The week before that, they were at gains. And the week in between, last week, they were showing much less, like 2,500 job losses per week. So they have a lot of flux in these numbers right now. This seems to be as important or more important than any softness in the economy. But they're saying it's demographic shifts. I'm sorry, let me say that again. These 13,500 job losses are probably more indicative of demographic shifts than it is any softness in the economy. I'm sorry, I misread that. Participation fell. Labor participation fell to, this is according to ADP, from 62.2 from 63.3 back in 2019. Workers are exiting faster than new entrants join because why? Okay, old people. And then you've got out-migration compared to in-migration of the last few years, or immigration, which was at record highs. And now you got out-migration, 2.3 million the last time the federal government reported. Okay, then we got the retail sales numbers this morning. I'm telling you, man, there's so much. And I'm going to try at the end, I'm going to try to wrap my head around the whole thing. Advanced estimates of U.S. retail and sales and food services sales for September. This is September, adjusted for seasonal variation, holiday and trading differences, but not for price changes, were up 0.2% plus or minus 0.4 from the previous month, but up 4.3% from September of last year. Total sales for July through September period were up 4.5% through September. This is a good economy. The July 2025 to August 2025% chance was unrevised from up 0.6%. Retail trade sales were up 0.1% plus or minus 0.5 and up 3.9 year over year in the retail sales trade when you take out auto. And non-store retailers were similar. They were up 6% from last year. Food service and drinking places were up 6.7%. Sounds like a good economy to me. The producer price index for final demand increased 0.3% in September. Remember, we're going back 2 months now. Prices for final demand goods were up 0.9. This is goods up 0.9, but the index for final demand services was at 0 increase. So with services being 80% of the 80% of the market, goods only being 25 or 30% of the market, then 0.9 increase on goods and 0 increase on services gives you the final demand at 2.7% year over year ending in September. The core came in at only 0.1% increase. Now the PPI, not nearly as interesting, not nearly as important as the CPI or the PCE, but you get some indication here that the manufacturers are not paying. This is a survey of purchasing agents, and they're not seeing dramatic increases. This is what I keep saying. It's like the press. There was a CNN report yesterday. That funny guy that does all the reporting on the stats, and oh my gosh, the consumer just sees horror in terms of inflation. It isn't there. But the press is making it appear that it is. The S&P Totality, the S&P Totality Case, I call it the Case-Shiller U.S. National Home Price NSA Index, posted a 1.3 annual gain for September, down from a 1.4 rise in the previous month. So we're just getting month after month in terms of the price index is low, 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 and going down. Inflation outpaced home prices for the fourth straight month. All 20 metros recorded month-over-month declines, not outright declines, although many are showing outright declines, but rather declines in the increases down in this lower range. This combined with we had elevated mortgages during that period. Remember, we're looking way back, okay? Well, you remember E.J. Antoni? Well, he's back posting daily on X now that he's no longer being considered for that federal government post. He says that the Chicago Fed is reporting that manufacturing still above the long-run growth in November. This is now, while service sector was below. Hiring slowed while planned hiring picked up. Planned capital spending decreased slightly and is well below trend. That's interesting. Outlook improved, turned optimistic. All of that sounds really good. All right, breaking in October, that's only last month, month-over-month pending home sales rose Northeast, Midwest, and South, but declined in the West. Year-over-year pending home sales increased in the Midwest and South, decreased in the Northwest and West. Overall, up 1.9%. This is in the housing market that is in trouble, right? All right, this is the consumers. This is the consumer confidence numbers. Now, this is the Conference Board Consumer Confidence Index declined by 6.8 points in November to 88.7 from 95.5 in October. This is November right now. Based on consumers' assessment of current business and labor market conditions, fell by 4.3 to 126. The expectations index, based on consumers' short-term outlook for incomes, business, and labor market conditions, fell by 8.6. It's been tracking below 80 for 10 consecutive months. It suggests recession ahead, but obviously no recession has come, with the GDP now at 4.2 for the third quarter. So the consumers are completely confused, I think, by the media. I think that's all it can be explained. Consumer confidence tumbled in November to a second lowest level since April, after moving sideways, according to Dana Peterson. All 5 components of the overall index flagged to remain weak. The present situation index dipped. One thing after another. Consumers were notably more pessimistic about business conditions. Expectations for increased household income shrunk, even though, as Mastercard's lady said this morning on CNBC, said real earnings are going up, have gone up every month since Trump has been in office. Among demographic groups, confidence continued to improve for consumers under 35 years old, but confidence for consumers aged 35 and older dipped, with respondents 55 and over remaining the most downbeat this year, even though the old folks are the ones that have all the money and have been making all kinds of money on the stock market and in their home prices. By income, confidence fell for nearly all cohorts after several months of increasing confidence. Consumers earning less than 15,000 was the only income bracket in which confidence improved. Well, if you're at the bottom. Confidence fell among consumers of all political stripes, with the sharpest retreat among independents. You can't make this stuff up. Trump this morning is at 46%. He's been 45 to 47% for the last 2 or 3 weeks. Truflation comes in this morning. Okay, here's the real facts, the facts on the ground. I go over these all the time with you. Truflation this morning comes in at 2.37. That is up 0.1. Goods, 2.34. All this concern about goods inflation, 2.34. The core at 2.16. Services at only 2.42, and the PCE at 2.31. How much better can it get than that? Okay, so what is the market? The market is getting all of this data all this morning, and what is it doing with it? Well, right now, at least for Tesla, it is down 2.28%. I don't know what about any of that data would have caused Tesla to be down 2.28%, but it's yesterday was up almost 7%, so maybe this is a little sell-off. Right now, it is trending down. The Dow Jones is up a little bit, 0.39%. The NASDAQ is down 0.54%, partially because of Tesla, mainly probably because of NVIDIA. And the S&P is down 0.05. So overall, it looks like the markets are saying, okay, we're not terribly concerned about anything we heard today. Not excited, not unexcited. You got Apple up, NVIDIA down 6% this morning to 171. You've got Microsoft down a little bit. Google, because of the same reason that NVIDIA is down, Google is up 2.84. All right, the VIX is back at this 20.70, about where it was yesterday. Been moving around a lot, but that's where it is right now. And then you've got the Cathie Woods, totally mixed, just about as many up as down. All right, let's go to the rest of the numbers. The bonds this morning, we are getting very close to the threes. We're down 2.5 basis points to 4.01. You can't get much closer to three than being at 4.01. So we might go into the threes today, but I should have done it. I should have said we'd be in the threes by the end of November, but I didn't. So I don't get credit for that one. All right, we've got the oil market down another buck 58, 57.26. This is not good news. This will mean more and more wells will be capped, especially the fracking people will have to cap. They can't make money at $57. Natural gas down 5.34. This is super good news. $4.30, dropping 21 cents since yesterday. Boy, this is unbelievably. I didn't have time to find out why, but I will check on that later today. We've also got GDP now numbers changing today. We got lots of stuff that I'm going to report on later tonight with Nicholas Gibbs. Okay, gold up $30, 4,124. Silver up a little bit more, 0.84% at $50.75. And copper up 1.1% today, back up over $5. So all of those inventory issues of having way too much inventory, maybe not so much, but we'll see. All right, we got the dollar mixed. We got Bitcoin down 2,000 to 80, almost 87,000 exactly. And Ethereum is down 2.66 at 28.96. So we continue to see a lot of negativity in that category. All right, so what's my overall take of this morning? My overall take of this morning is that the economy is doing fine. Manufacturing, I think, is okay, but I think it's going to do better. You've got people starting to talk about higher priced goods, which would include durables. If the durables business picks up as the Fed lowers the rate in December, we start to see more and more people buying those durables. This is going to pick up the part of the market that has been softest. If the interest rates are going to come down into the threes, that means that mortgage rates are going to come down, and that will help stimulate the housing market. So overall, it's continuing to be the pattern that I've been talking about. I think this is exactly on case. But what we're seeing is the consumer who is spending like crazy. They're spending like they're confident, but they're telling the pollsters that they're not confident. And the lady from Mastercard also mentioned this. She says she's seen this before, where the consumers are saying one thing and acting in another way. And this is hard to figure out, especially if you believe the consumer confidence numbers this morning, where they're saying that it's not really as political right now. But I think it is political. I think that there is a political nature right now. We're seeing the overall belief that the country's headed in the right direction drop right now. So I think there's a lot of political angst. That's the right word. There's a lot of political angst right now, and I think this is impacting the consumer confidence. You have the consumers continuing to say that they think that inflation is going to be at 3.7 or 4.2 or whatever. There's nothing out there. There's zip zero. There's nothing right now that would cause them to think that way. Their grocery bill is only barely going up. Their what do you call it? Gasoline bill is going down. Overall energy prices down, oil prices down. I keep mentioning natural gas as being the outlier, but we're not really into the cold snap yet. So I don't think people have gotten those giant natural gas bills yet. So I don't know. I don't know where the consumers are getting it other than the mass media. Let me know in the comments below. Why do you think the consumer is so out of step with the actual, remember, GDP now is saying 4.2%. The actual business climate, is it because they're being beaten down by the AI fears, they're being beaten down by the tariff fears, and they're being beaten down by the mainstream media continuing to talk like inflation is still horrible and not telling the truth? What do you think? I'd really be interested to know. So that is the story today. Nicholas Gibbs coming up later tonight. Brian White will be right after that at 7:45 roughly. Nicholas Gibbs maybe a little early. He's been wanting to go a little earlier, which is fine with me. And last night, yeah, you got to go watch Larry. If you didn't watch the show last night with Larry and I talking about what's happening with NVIDIA and what's likely to happen, I think while Larry was definitely saying no to price pressures on NVIDIA, I was just bringing it up. I wasn't saying there are. I was just bringing it up as a maybe for 2 years from now. Well, apparently, Meta, while we're talking about it, Meta's going, I'm going to switch carrier. I'm going to switch horses here, and NVIDIA down big time today. All right, that's all I got for you. I'll put the card up, of course, to go see that Larry's situation. Oh, and the Larry co-hosting last night. Let me just go back real quick on Tesla and see what we've got going on. It's still down 2%, $4.09. Yeah, I don't know. Yeah, it's a hard call. We're Thanksgiving week. I think the market recovers. I think when they read all of the data, they really get a sense of where the data is. They're going to see strong Christmas. Next year, crazy strong. Nothing to worry about. Therefore, I think we're up and to the right. That's all I got for you right now. It's been great talking to you.